Pranav Gundlapalle from Bernstein joins us on the show to talk to us about the banking sector. Remember, this morning there was a big note that came in on Greed and Fear as well, talking about the banking sector and how perhaps the ownership, despite being quite high, there are various verticals of the market that might look at investing more into the private banking sector. Pranav, that's exactly the first question. The private banking space, especially the large cap banks, haven't done much at all in the last many months, despite the decent show as far as earnings is concerned. What explains that dichotomy as per you?
See, I think there are two things happening here, right? So I think one, you've had pretty much the rest of the sector outside the top four banks really seeing a big earnings improvement as the credit cost normalized, right? So you had the momentum of a big year-on-year growth in earnings numbers. So that led to their re-rating. So that is one thing which is happened. The second is also that over the last 12 to 18 months, you've had a bit of a convergence of the operating metrics as well. So if you look at in many quarters last year, some of the smaller public sector banks were reporting the same growth and ROE numbers as some of the large private sector banks. So I think these two would be the key reasons, I would say. And you are seeing signs of those, again, weaning away. Right? So I think you are seeing the operating performance diverging. Now you have growth, which seems to be higher for the private sector banks. So I think some of that will drive interest back into the large private sector banks.
Do you think best of the earnings momentum is behind private banks? Because NIMs now, in a sense, will peak out. Competition will only intensify. Fintechs are becoming more and more stable now as businesses, which will eat into their market share.
I think one thing which has happened structurally is that the Indian bank, especially the private sector banks, will have a more cyclical earnings profile going forward, right? So if you look at the last 15 years, the NIM have been flat irrespective of what happened on the benchmark rates. Now that has changed, right? So you will have that cyclicality. So yes, on a NIM front, we are past the peak for sure. But what the banks do have is they have other levers to pull. The OPEX, for instance, is the OPEX growth is at a much higher pace than what I would call the normal pace. All the banks have built up a decent amount of credit cost buffers. So they would start using that to make sure that the earnings trajectory is smoothened out to a certain extent.
Okay. What is the best way of looking banks? There are two type of banks. One retail dominated, second wholesale dominated. Where do you think in the near term there could be more bang for buck?
See, I think at the end of the day, it comes back to what is the ROA, or at least return on risk-weighted assets. So I don't think it's fair to call retail better than corporate. It's not always the case. The retail is generally more stable, which is why investors tend to like it, because it's granular, and therefore you will not have the same volatility that you have with large corporate lending. So that's the only reason. But from a returns perspective, I'm more bullish on the corporate segment coming back, because that is a segment which has not seen growth for almost 10 years. And now you are having all the right indicators suggesting that the demand for corporate credit is going to come back. And that could be the next big catalyst for the sector.
Okay, point taken. But we were also discussing this PSU banking space, right? Pranav, what's your view on that? Do you think the bulk of the rally is behind, and it's probably advisable for investors to probably trim their positions there, or it's just time to reach on and take money off from, let's say, just the large cap PSU names to maybe even the smaller ones?
See, I think the large part of the re-rating is done, right? So I think you had that re-rating rally from banks at 0.4, 0.5 times price to book to 1 times or 1.2 times. So I think that explained most of the performance in the last 1 to 2 years, and that is done, right? Now what we have is going to be more of the usual compounding, returns from compounding, which might hold on for a while. So yes, one could stay invested, but the expectation should be more nominal, right? So if they grow in line with their ROEs, which is not too bad right now, but that's all there's going to be. And that growth differential, I think, is also going to start to show up. So I think this quarter, you've started seeing the large, some of the public sector banks come out with deposit growth numbers that are, at best low double digits compared to high teens or almost 20% plus for a lot of the private sector banks. So that growth divergence will start to kick in. So that will ensure that there is no further widening of the valuation multiples, but no risks as such for the PSUs where you should expect a multiple derating at this stage.
I request you to stay with us. We'll come back after a very short break and also look at the other lending pieces beyond banks as well with you on the other side of this very short break.